Okay, let's get right into it. Today, we are going to unlock one of the most powerful, yet believe it or not, one of the simplest secrets to building real long-term wealth. And no, it's not about some crazy stock tip or trying to perfectly time the market. It's about understanding a fundamental force that's available to all of us.
So let's start with the big one, the question that I think is on pretty much everyone's mind. How do you get your money to stop just sitting there and actually start working for you? Pulling its own weight and growing all by itself?
And here's the fantastic news. The answer isn't some complicated secret locked away for Wall Street insiders. It is an incredible engine for growth, and it's available to every single one of us. It doesn't matter if you're starting with $10 or $10,000. It's a principle that can totally transform your financial future.
And that principle is compound interest. It's a concept so powerful that Albert Einstein himself supposedly called it the eighth wonder of the world. So let's break down exactly what that means and why it gets such high praise.
So what is it really? Well, put simply, compound interest is interest on your interest. It's a two-step process. First, you earn a return on the money you initially put in. Then, you start earning a return on that return. It creates this powerful, self-sustaining cycle that just builds and builds on itself over time.
Now, to really get why this is such a game changer, we have to compare it to its much less exciting cousin, simple interest. And trust me, when you see them side by side, the difference is, well, it's night and day.
Okay, so check this out. On the left, you've got simple interest. You only ever earn interest on that first chunk of money you put in, the principal. That's it. It's a straight, predictable, kind of boring line. But on the right, that's where the magic happens. With compound interest, the interest you earn gets added back into the pot, which means the next time you earn interest, you're earning it on a bigger amount.
Now, this is where the story really gets good. Let's look at $1,000, invested at a 10% annual return. In year one, see, they're exactly the same. No big deal. By year 5, you can start to see the compound balance pulling ahead, just a little bit. But then, watch what happens. Look at year 10, and then all the way out to year 20. That gap between them isn't just growing anymore, it's accelerating.
And boom, here's the punchline after 20 years. That compounded investment has snowballed into over $6,700. The simple interest account, it's sitting at just $3,000. That's a difference of more than $3,700 from the exact same starting point. That is the magic right there. Your money literally started making its own money. So you're probably thinking, okay, that's amazing, but how do I make that happen for me? Well, the great news is you're in the driver's seat. You have control over this engine. There are 3 main levers you can pull to make this process work even faster and even harder for you.
And these are the 3 key ingredients. First, there's time. That's how long your money has to grow. Second is the rate of return. That's how fast it grows. And third is frequency, which is how often your earnings get reinvested back into the mix.
Let's talk about the single most important ingredient of them all, time. Let me paint a quick picture for you. Imagine early Ellie starts investing $100 a month at age 25. Then you have late Larry, who waits until he's 35. But to catch up, he invests double that, $200 a month. Now, who do you think ends up with more? It has to be Larry, right? He invested way more money. Nope. By age 65, Ellie has around $50,000 more than Larry, simply because her smaller amount had 10 extra years to work its magic. This quote says it all. Every day you wait is a day of growth you can never get back.
Next up is the rate of return. Think of this as the speed dial on your growth engine, and this is where your choices really matter. You've got safer options like high-yield savings accounts that offer lower but steadier returns. Then you have things with more growth potential, like ETFs, which are basically just baskets of different stocks. They offer the chance for higher returns, but they also come with more risk. The goal is to find a balance that you are personally comfortable with, because even a small bump in your rate of return can make a massive difference over the long run.
And finally, we've got frequency. I like to call this the hidden turbocharger. It's a little more subtle, but an account that compounds daily is going to grow just a little bit faster than one that only compounds annually. Why? Because your interest starts earning its own interest that much sooner. It's a small detail that really adds up over the long haul.
All right, that's enough of the what and the why. Let's get to the really good stuff, the how. Let's talk about some simple, practical ways you can activate this financial superpower, like right now. Seriously, the absolute best place for most people to start is with a dedicated retirement account. You've probably heard of a 401k through an employer, or maybe an IRA, which is an individual retirement account. These things are just built for compounding. They give you a super long time horizon, they have incredible tax advantages, and very often they come with a game-changing bonus. And that bonus is the employer match. Listen, if your company offers to match your contributions, it is, and I mean this literally, a 100% return on your investment instantly. You put in $1, they put in $1. There is no other investment on planet Earth that can guarantee you that kind of return. It is free money, and it's the ultimate accelerator for your savings.
Now, for money you might need sooner, like your emergency fund, a high-yield savings account is a fantastic tool. It's safe, your money's accessible when you need it, but it's earning so much more than a typical savings account. It lets you actually see that compounding power in action every single month.
And one last pro tip, if you're investing in stocks or funds that pay out dividends, you've got to make sure you're reinvesting them. Most platforms let you do this automatically with something called a DRIP, or a dividend reinvestment plan. It just takes those little payouts and uses them to buy more shares. Those new shares then earn more dividends, which buy even more shares. You see where this is going. It becomes this beautiful, self-perpetuating growth machine. So when you boil it all down, this is what it looks like. It's a journey. It starts small, with whatever you can put away. But through the quiet, relentless, unstoppable power of earning interest on your interest year after year, those small amounts can truly grow into something significant. It's a process that rewards patience and consistency more than anything else. So that leaves us with just one final question. Every single dollar you have holds the potential to start working for you to become part of this engine. The engine is sitting there, waiting. The only question is, when will you turn the key?